Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. And today we have an excellent presentation on a type of investing called net real estate investing, net lease investing. And it's typically categorized by single net, double net, and triple net. We're going to talk about how all of those work. But we're also going to talk about how this type of investing can fit in different areas. So we'll go ahead and get started here. So what is net lease investing? Well, it's a type of commercial real estate investing where you are the landlord for a big, powerful company. You might be, if you're in the United States, you could be the landlord for McDonald's. You could be the landlord for Walgreens. You could be the landlord for CVS. And you also can do a net lease with a tenant that is called a non-credit tenant. A non-credit tenant is a small company that's not powerful like Walgreens or McDonald's. But you can also do net lease with them, but you have to make sure you know how to price things. So a single net lease, the tenant has to pay the taxes in addition to the rent. Normally, if you're a residential landlord, you have to pay the taxes. But if you're a commercial landlord and you do a single tenant net lease, the tenant has to pay the taxes. And if you do what's called a double net lease, the tenant has to pay the rent, the taxes, and the insurance. So this is sounding great. If you're a landlord, you are putting more and more of your responsibilities on the tenant's back. What's not to love about that? And then a triple net lease, a home run, is where the tenant has to pay the rent and all the insurance and the taxes and lots of things on the tenant. So now we're going to take a look at some examples of net lease properties, and we're going to talk about an important metric called a cap rate. We'll do that in another slide. But first, I want to show some examples. But what I want you to notice in these examples is the percentage for the cap rate, how it is a low number, like 4 or 5, something like that. So we're going to look at some deals here. So these are some listings. This is put together by a brokerage that they put out this brochure, but it's a nice example here. So you can see some Dollar General, that's a net lease, 7-Eleven's a net lease, Taco Bell's a net lease, AutoZone, all these are net leases. Now look here, there's some listings that are out on the market. There's 139 7-Eleven net lease deals there's 139 net lease deals that are available in this particular commercial market. And you can see that the cap rate on those net lease deals is about 4.9%. You can see that there's a range on that cap rate from 3.5% to as high as 7%. So you can kind of get a feel for everything there. And then we've got a few more examples: AutoZone, Bank of America. You can just look through, and these sorts of deals are they range, but you're going to find that a quality tenant has a low cap rate. That's just the situation on these types of things, where if you've got a high quality tenant, here's a great one, Chase Bank. If you look at Chase Bank, in this example, a cap rate of 4.6%. So very low cap rates, but definitely something that's interesting, and you can kind of get a sense. Chipotle, Chili's, lots of tenants, but we're going to talk about what drives all of that. So we'll go here, and we're going to go back to the calculation of the cap rate. I'm not going to go through this in a lot of detail, but basically you just take the net operating income and you divide it by the price. That's how you determine the cap rate. But one thing that's important for investors to know is that high quality tenants, they have low cap rates. Whereas a lot of investors, they make a mistake where they chase a high cap rate. They think, well, I'm going to make more money, so I should go buy some high cap rates. And that's actually very dangerous to do. You can have a lot of problems doing that. And I'll give some examples, but we've got several different lease types. We've got the single net, the double net, the triple net. And the interesting one, there's also one that's called a bond lease or an absolute triple net. And that one, the tenant is 100% responsible for everything on the property. Even if the building burns down, the tenant is still responsible on that sort of lease for paying rent. But you can kind of get a sense here for the less responsibility to the landlord, the lower the cap rate you're going to find. Whereas if you go to a single net lease, it's going to have comparatively a higher cap rate compared to a double net lease or a triple net lease, because the less that the landlord has to do, the lower the cap rate. Now, if you compare a net lease investment, let's look at an investment grade bond yield. And if we look at this over a period of time, you might see a yield that's as low as 2%. You know, this changes a little bit, but if you compare it to a triple net cap rate, actually the triple net pays more than an investment grade bond. And it is almost as good, but it pays significantly more. Sometimes people ask the question, well, that doesn't make sense. Why would a big company rent? Don't they have enough money just to buy their own place? Well, they absolutely do have enough money. But it is a business decision where they have made the decision that by doing a net lease, they will have more capital that is available for their core business. So maybe they can get a much higher rate of return on their core business. If they're in the drug business, say Walgreens, they can get a far higher rate of return than real estate investing. But it is something that's interesting. And now I want to make this as clear as a bell. I want to make it crystal clear how this works with high quality tenant versus low quality tenant and the difference in the cap rate. So if we take McDonald's here as an example, this is a real listing. This building is being sold for $1.659 million. And you notice how low that cap rate is, just 3.85%. Boy, that is a low cap rate. So you know, that's not something that's going to generate a tremendous amount of income, but it's pretty safe. And now look at this. Look at this. Maybe if you're a new investor, you think, I need a higher cap rate. Well, look at this beauty. 25% cap rate. Wow. 25% cap rate. That is so much more. And that is the type of thing that can catch a lot of new investors that don't know what they're doing. Is they may get attracted and they may buy this sort of an asset. Now, the problem with this sort of an asset, I don't know this particular, I just pulled it as an example, but this is a building that's being sold in Texas for $800,000 and they're offering a 25% cap rate. So they are telling you, if you buy this building, you can get income of $200,000. Well, that sounds great. I mean, that sounds a lot better than that 3% on McDonald's or 4%. But the problem with this sort of deal is you may purchase that building for $800,000, and then after the transaction closes, maybe a year later, maybe a few months later, all of a sudden the payments stop, and the tenant tells you, you know, I had a fireworks stand here and business was going great, and you can even see there's a fireworks stand there, but now there's a problem in the business and I can't pay rent. And it's very likely that the owner of this building is the one that is offering a 25% cap rate. I don't know that. I'm just making a guess. But that's a risky deal to buy. So that's what can hurt new investors, is they sit back and they have read what a net lease is. They think it's going to be a great way to make money. They're going to get passive income. This one, you know, it might even be, this one is a triple net lease. So I feel badly for the investor that buys this thinking that they're going to get a long-term $200,000 in income per year. Now, let's take the example here of a vacant building. And this is a great example. It shows how much different residential and commercial real estate is. So we have at first an empty building that has no tenants, and that would be valued by a comparable sales approach. So in that case, when the building is vacant, they use a comparable sales approach. And let's imagine that that building has a value based on comparable sales and square footage of 400,000. That's what other vacant buildings and that similar square footage sold for. Now let's imagine that Joe's Plumbing comes in. Joe's Plumbing comes in, and Joe's Plumbing leases that building. And you bought the building for $400,000. Joe's Plumbing comes in. It's a local plumbing company, and they want the space. And they work out a deal to pay you $10,000 a month. And you sign a 15-year lease with them, and you're real happy about that. Well, the good news is now that you've got a tenant, the value of that building is no longer $400,000, it's $800,000. Of course, you have what's called a non-credit tenant, and that's not as good as a credit tenant. And I'm going to show an example here. Now let's imagine that you hit the jackpot where you purchase this building and you are approached by Dollar General. And Dollar General, they come in and they say, we like your building, we would like to lease it. And you say, okay, great. How much rent are you going to pay me? And Dollar General says, well, we're going to pay you $10,000 a month. And then we're going to do some price bumps to pay you more rent over time. It is a great opportunity. So you sign a lease, even though both of the tenants are paying $10,000 a month in rent. The credit tenant, the Dollar General, has now moved the value of that building to $1.6 million because Dollar General has a very low cap rate. We saw earlier that you might be looking at a 4 or 5% cap rate. So these are things that are important. So when you're the landlord, you want to find high quality credit tenants. That's the solution, because everything is not equal. The other thing that I will say about net lease is that the advantage to it is it's very passive income. It's not like a multifamily property. It's not like something that has as much work involved for the landlord. There's often no landlord responsibilities. And now I'm going to just show as an example a LOI here and a lease. This is just a thing I'm going to show real quick.
The normal way this begins is you submit what's called a letter of intent. And here is an example of a letter of intent. This was on a Dollar General that was located in Abilene, Texas. The price of it was $1.695 million, and earnest money was $10,000. And there was a 45-day inspection period, financing to be determined, and then it had some other things with the transaction costs. But this is how the process starts. This is before you have an actual contract. This is called a non-binding letter of intent to purchase, and it's what your first step towards purchasing a net lease property. I'm going to show an example of what this looks like. There's a company in the United States that's called Dollar General, and they actually have a lot of stores. They've got thousands of stores. It's a big corporation. And this was a deal that was in Abilene, Texas.
Okay, so that's what a net lease looks like. And now these deals are also sometimes syndicated. It's quite common for somebody that has the knowledge on how to do net lease. They go out, they source the deal, then they'll put a contract on it to purchase. They'll put up the earnest money to tie the deal up, and then they will reach out to their friends and they will syndicate the deal where everybody gets some ownership in it. Now let's talk about the sort of investors that like net lease, because it's a totally different category. The type of investor that is attracted to net lease is one that is older, that they basically are retired, they have money, they want more than they can earn on an investment grade bond, but they want to not do any work. They don't want to be a landlord. That's a net lease investor as an individual. And then you also will find a large number of pension funds that just love these net lease deals. They go and they participate in acquiring a lot of trophy assets. So those are kind of the two categories. This is not something you invest into if you're looking to double or your money, or you're trying to make a bunch of money. This is, if you're trying to make a bunch of money, you want to go in the direction of multifamily, not so much net lease. But you can make a lot of money if you're an operator that knows how to structure deals, if you can go out and get a lease on a vacant building, and then if you can bring a tenant in, you can make a fortune in net lease, but it's active investment. It's not passive. So that's how net lease works. Just a couple of reminders. We have a sign-in sheet, and I just asked that in the chat window, there's a chat window, and your name hopefully is on the sign-in sheet if you registered, and if not, you're always welcome. I'm glad you made it, but you can put any information that you want there about yourself. And then I send this out to other investors, and sometimes there's an opportunity to network and meet people. You'll also receive a copy of the sign-in sheet. So, and then I also am available for new investors that are wanting to learn how to do different deals. I'm also available to help with that. I'm going to go ahead and stop the recording, and then I'll open it up to any questions if anyone has any questions.